What's up, everyone? So, I've been teasing this for a while. I'm finally doing it. I'm finally just going to start a YouTube channel. This is going to be the easiest way to share with you what I've learned this last year, and hopefully, help you create some of the same results I've had. So, I started learning how to sell options last about this time of year, actually, around November, December, which is interesting because I got laid off from my job in March. I didn't know that was going to happen. Obviously, this is just something I actually started learning how to do because. Um, I was getting ready for my bodybuilding show. I was super bored on the treadmill for 2 hours a day, and I wanted something to kind of stimulate my mind while I did my cardio. And this is what I stumbled upon. And honestly, it's changed my life quite a bit. So now, where I'm at almost a year later, I have two portfolios. I have one that I strictly trade options in, one that I do like a high yield dividend investing approach. And I use both them kind of in conjunction. I'll move funds back and forth. I'll move stock that I've been assigned back and forth to kind of create more premium. And I'll show you all that. We'll get into all that. So I don't want to, waste too much of your time up front. I want to make this pretty quick for the first video, just to give you a high level introduction, get some engagement going, get some questions uh, stimulated so we can kind of dive into this together. So, module one, introduction to options. What are they? How do they work? Why are they so amazing? All that good stuff. Okay, here's the agenda. I won't go through every single one with you right now, but obviously you can, pause it, read these through. That's everything we're going to go over. Like I said, we're not going to spend too much time, go too much in depth. This is just to give you an understanding, kind of start your, so to give you somewhere to start your own research at. So, what is an option? An option gives the buyer the right, not the obligation, to buy or sell a stock at a specific price before a set date. Sellers get paid up front for taking on that obligation. The way I want you to think about this is you're essentially becoming an insurance agent, stock insurance. That's what put options are if you're buying a put option. Okay. So, um, for example, let's say, for example, that you bought or that someone bought Apple at 200 a share, and now it's at 250 a share, and they want to realize that gain and protect their downside because maybe they're nervous that, there's going to be a crash, a correction, whatever. They buy a put option at 250. Okay, and they pay a premium to buy that put option because insurance is expensive, just like your car insurance, house insurance, it's expensive. So they buy that put option. You are the seller of that put option. You're the person on the other end of that contract saying, if Apple drops below 250 by this date, I will buy your stock from you. That's how that works. And they pay you that premium up front because, like I said, insurance is expensive. So, call versus put, the seller's role. So, selling a call, you agree to sell stock at a price. So, let's say it's stock that you own or you've been assigned and you are generating premium off that stock, kind of like a rental home. You're selling a call against the underlying shares that you own. And it's the exact same process I just described before, but in reverse. Okay. You own the stock. You're saying, hey, if this stock that I own is at this price by this date, I will sell it to you. And the person on the end of that contract pays you that premium for doing that. Selling a put, that was what we were just talking about before. Okay. You agree to buy stock at a set price. In both cases, you collect premium up front. Okay. So sellers, look down here, sellers take on risk in exchange for consistent income. This is just a quick little chart that shows you the time decay aspect of selling an option. So because there's an expiration date, that contract only has value up until it expires. So you essentially have this decay that happens, and that's what this curve, this bowed curve is right here. Okay, you have this decay that happens in the last 30 days, and I don't want to jump too far ahead because we're gonna get into it in the next slide. I just kind of want to show you what this looks like before we actually get to that section. So why sell options instead of buy? There's a higher probability of profit. If you're buying an option, you're essentially the guy walking into the casino betting, there's a 50-50 chance the stock's going to go up to the price that you chose as the strike that you bought. And so it might go to that price, but it might not, right? You're gambling. You don't know. Especially when it comes to statistics, you're split on that. It's going to go to that price or it's not. Time, so the profitability works in your favor when you sell. Time decay, theta works in your favor. So that chart that we just previously looked at, every day that goes by, that option is becoming less and less valuable. And you as the seller, you gain the upside in that decay. Essentially, every single day, a little bit, a little portion of that value, let's say it's $1. We're just throwing out numbers. Let's say it's $1 every day that they're losing on that option because of that time decay. That dollar is going in your pocket every day, essentially. And this creates an ability to generate income on stocks that you own or that you want to own. That's kind of the cool thing about selling a put is it's a stock that you want to own at a price you want to own it at, and you're getting paid for that process. All right. So key terms that you will hear, that you will see, that you want to know when you're talking about selling options. Okay. Strike price. That is the agreed upon price for the stock. That's the price you are choosing as the seller to either buy someone's shares if you're selling a put or selling stock that you own if you're selling a call. That's the price that you're willing to buy or sell. Expiration, the date the contract ends. Premium, that's what you receive for selling. That's kind of the whole point of this. This is um, this is the income. So in the money, at the money, out of the money. I don't, this is going to be confusing at first. It's going to become very not confusing soon once you start looking into this, doing some research. Essentially, at the money, this is where the stock is trading. In the money is below where the stock is currently trading, and out of the money is above where the stock is trading. Um, I maybe should have done this vertically. That would have made more sense. My beautiful wife. You want to come say hi? She says no. Okay. So this is going to be the awkward part of this for me is like just doing my thing while the dogs are doing their thing, the kids, the wife, all that. But it's all good. We're all taking this journey together. So the power of option selling. So the whole point of this is to create steady monthly income. And the way I like to think about it, honestly, is it's kind of a way that you're paying yourself dividends on stocks that you own because not every stock pays a dividend. And usually the stocks that do more traditional payers like Coca-Cola, Target, some of those bigger names, they pay I mean, let's be honest, they pay a super small dividend, usually quarterly, sometimes annually. And if you don't have a lot of money in that stock, you're just not making very much on it. And the compounding cycle is taking a lot longer than it needs to, where you can just generate 2% a week and compound at a much faster rate. And that's actually what I focus on is about 2% a week and I'll show you how to do that. So how premiums and payouts work. Example, let's say you sell $100 put for a $3 premium. Okay. So again, this can be any stock. It doesn't matter, right? That's the price it's trading at or around the price it's trading at, and you choose to sell the $100 strike and make $300 of premium for it. You collect $300 up front. As soon as you click sell that option, you're getting that right in your account, your cash balance immediately. If the stock stays above 100, you keep that premium. If it drops below 100, you may be assigned the stock. But again, that's okay because that's the price you wanted to own it at. You like that stock and you got paid to do it. So, it's pretty, pretty amazing. Um, so time decay, theta. So going back, I should put that chart on here so you could see it again. I will revamp this for, when I send this training out to everyone. Um, So the time decay component is what makes us so amazing. This is what makes it work so well. That last 30 days is when an option decays the fastest. So whether you're selling, you know, uh, monthly options, 60 options, weekly options, doesn't really matter. It's up to you. I like to sell weekly options, but the last 30 days is when it decays the fastest. So as a seller, this works in your favor. You profit as time passes. You're just selling time. The volatility of a stock is what pays you, and we'll look at that in the next slide. That's where the premium comes from, is the volatility, and the time is what you're selling. Okay. And if the option stays out of the money, right? So you just collect the premium and you don't get assigned the stock, so you keep your cash collateral as well. So here's a visual of an options chain. Okay, anytime that you're trading options, depending on what brokerage you use, you're going to have an options chain. It's going to look similar to this. It may be slightly different depending on whether you're using Robinhood, Webull, E-Trade, Fidelity, whatever. They're all pretty similar. They have the same information, just laid out differently. So this is what it typically looks like. So right here on this stock, you've got this line right here. This is the current price where it's trading. If it's up or down during that trading session, these strikes all below it are in the money options because the stock is trading uh, right here, and these strikes are below where it's trading. This one right here is out of the money. That 72 is out of the money. Okay. Now you see an ask and a bid, you got a call side and a put side. So depending on whether, so just to give you a quick example, if you're trying to sell a put, you don't own the stock, but you want to, and you're selling a put, you're coming down here and you're looking, okay, what risk do I want to take on? Or what price am I willing to own the stock at because I like it? Okay. And as you can see here, these bids, this is the low end of what you're getting paid per share on that option. An options contract controls 100 shares of stock. So for this option right here, this 71 strike, you're looking at minimum $340 for that option contract. Okay. And that depends again on the time that you're selling that option for. And then you've got the put side, and you can't really see it over here. But if you look on this side, let's say you own the stock. Okay. Let's say you own this stock. Let's say you own it at 71 just for fun. Okay. That would make this example easier. If you were selling this call, $520 is the minimum that you would make for selling this call at this strike. Now, that's pretty amazing, right? We'll get into later the nuances of what strike price you'd want to choose and what time frame you'd want to choose that option to expire in, because that all plays into the premium, the risk, how quickly you can compound those gains, all of that. So this is just to give you high level, just a real quick visual for you to kind of wrap your mind around. Um, so that's module one. So I'm going to if you subscribe to my channel, I'm going to send this to you free, just for you to have, so you can study and have that in your back pocket. And obviously, you can ask me any questions in the comments. You can, if you're a friend or family member, obviously you'll probably have my number already and just text me on the side or whatever. But for those of you that aren't friends or family, that are soon to be friends and family, if you subscribe, I'll send you this. Please like, share, subscribe, all that good stuff. This is the very beginning of this, so I know it's choppy and it's kind of amateur hour, but it will get better. I'll get better at this over time. Essentially, I'll be an amazing content creator, but for now, I don't really care. I just want you to get value from this and learn something that could really help change your life. So